Hi Gary,
Leo.
it's been the weekend. It's been a week since our last video. Thought we'd catch up again and ask, how's things been?
Well, they were pretty good until this morning, quite honestly. You have these, there's a certain routine we follow in investment team, and that is that, for me personally, alarm goes at 5 o'clock in the morning, reach across, look at Bloomberg, and you can see what's happening with the futures market. And you can see the futures market for the UK is down 6%. And then you track to Bloomberg News and you see why, and you get up, shower and come into the office, and then you begin to track things. It doesn't happen very often. It hasn't happened for a few years, probably since 2016, and we had the referendum on Brexit, and the pound got shot to pieces. So I was mightily relieved driving into the office that we were running very, very low equity levels. We've been very cautious. Actually, one of my main fears was there'd be a big recovery in markets, but that didn't happen. So we've got lots of cash, and the team are all working as we speak on looking at whether we should be investing any of it.
So obviously the markets are the key point of focus for us. But with the ongoing activity around the coronavirus and the increasing positive testing, is that having any impact, or have we seen the market's response and now it's a case of riding it?
I think the issue you have at the moment is that we are all dealing, particularly the West, we're dealing with something that we're not used to. As I said last week, the last pandemic was 68, 69. So I can't remember that, and I was 10 or 11 at the time. So most people that are alive in the West today have never experienced a pandemic. And that makes things quite difficult to deal with and to predict. It's unnerving when people go through new experiences. So we've been tracking back on what happened with the last three pandemics. And yes, they are disruptive to the economy because workers get infected. That means they're sick, big demand on the health services, less people to produce goods, but that's matched by less people buying goods because people don't consume a lot of things when they're sick. So you're looking at the economy dropping down significantly in a quarter and perhaps 2 quarters and perhaps hitting a technical recession. But in each of those pandemics, the economy comes out the other side and you get pent-up demand being met as things go back to normal, and so you get a boost. And the issue for us, therefore, is when do we begin to commit lots of the cash that we've got back into markets? And that's the challenge we've got at the moment. But overall, we see this COVID-19 as having an effect on economies of the world through 2020. But as things move through and people have overcome it, as has happened previously, things get back to normal. As they get back to normal, as markets look through to the end of the pandemic, they will begin to respond positively.
So you've not been looking at the funds over the weekend and panic buying toilet rolls?
Well, I've not been looking at the funds and panic buying toilet rolls. I've been looking at the toilet rolls in the Reynolds household and wondering whether perhaps we should have panic bought some toilet rolls because we're going to be short toilet rolls. And which is an interesting point because part of the shortage of toilet rolls will be to do with the amount of buying, because people start buying strange things. Vodka was being bought last week before people began to realise that the alcoholic content isn't quite high enough to get rid of all the germs off your hands. But washing your hands in vodka seems to be an extraordinarily expensive way of remaining hygienic. Why not just wash your hands in hot water and soap, which is the best way of doing it? But on things that there's a shortage of, it's for two reasons. Sometimes people are buying and hoarding, and you can understand that, and actually they're responding positively in a normal human way to a problem. But the other difficulty is that global supply chains are rattled at the moment because people in China have not been as productive recently because they've been off sick, and factories have been shut down to prevent healthy factory workers getting sick, and it has an effect on global supply chains. Those supply chains will respond. They're remarkably flexible, but they cause disruption in the short term, and we're back to this issue of market uncertainty. You can't necessarily see where the disruption will have the biggest impact. So as people get nervous, they block sell across a lot of different stocks. Whole markets go down instead of discriminate selling and buying.
Sure. So people out there on the streets will go in and buy in bulks of the hand sanitizer, and then they're going onto eBay or Amazon and they're selling it at hugely inflated prices. You don't get that kind of thing in the professional investment world, I imagine.
You imagine wrong. I think you get that type of thing in the supposedly professional investment world all the time, but you've got to look for it. And I think the great mistake that the amateur investor makes is to think that the professional side of the market is full of sensible people doing sensible things. Look over the past few years on some very silly things that supposedly highly professional people have done. And we're always mindful of the fact that we're human. You don't want to make that big error and do something really silly, which is why you put in place so many sort of risk controls. But daft things do happen. Professional fund managers can make equally as stupid decisions as non-professional investors.
Does make complete sense. Okay, so I guess we'll just continue to monitor activity and keep clients up to date as much as possible.
Yeah, and I think one thing that I think we should make clear is that this is going to present some decent buying opportunities. We have no doubt about that. I mean, as I speak now, you can buy the FTSE 100 on a dividend yield of over 5%. Compare that to what you get on 10-year gilts at the moment, which is a fraction above 0%. You're not even getting anything near 1% at the moment. Look at the two on the long term. Where would you rather be? A block of stocks paying over 5% per annum, or a 10-year UK government bond paying you just over 0%, barely in positive territory? It's a non-brainer. But we're looking very carefully at this because what we don't want to do as fund managers is to commit all that cash irresponsibly. However, we're also conscious that we're here to manage money for the long term. And right now, if you said to me, I've got £100,000, I've got to put it in either the FTSE 100 stocks or a 10-year gilt for the next decade, where would it be? It is a non-brainer. It's the FTSE 100 stocks. And that tells you that right now, for the long-term investor, there are some great bargains out there.